good morning for some of you, good afternoon. We'll give everybody just a moment or two to log in and join the event before we kick things off, maybe a few more seconds. Yeah, I can see some of the numbers are going up here. We will, obviously, we are recording this session and we'll make it available. Okay, I'm going to get started. If we end early, we'll end early, and if not, we'll go the full length of time. Feel free to use the chat feature, or better yet, use the Q&A feature. It's a little button there. Feel free to ask any question along the way. We love live questions. We love to answer things on the fly. It's more fun for us and keeps us on our game. So, okay, as I see some of you are still rolling in, I'll just give you another couple more seconds here, and then we'll kick off contract negotiations. This is a best practice workshop. I just want to spend a couple of minutes. First of all, my name is Lisa Reisman. I'm the CEO and founder of Metal Miner, and I'm joined by my colleagues, Don Hauser, who he has an internal name of Steel Czar. He has an external name of our Vice President of Business Solutions, and Nicole Baston, who is our forecast analyst and is going to give some current information on some of the metals that we track. So a couple things just to kind of get started. Some of our workshops have been very focused on giving actual forecast and forecast information. We have peppered this discussion with some current information. So we will be covering aluminum, nickel as it relates to stainless steel, and some of the carbon steel products as well. So we will give some overview, some forecast, and then more important, explain why we're doing that. And I think the why it's really important as we enter contract season. And we think the season kind of kicks off now in August. So companies are starting to do their homework and begin thinking about what they're going to do for next year. So with that, I'll click to the next slide. From our vantage point, the big problem here is making sure that you're setting the right contract strategy. I know later in the presentation, we'll kind of go through some of the strategies that people were able to deploy last year are not the same strategies you're going to want to deploy this year based on today's market conditions. And again, everything changes, right? And some of you contract on the earlier side in the September, October timeframe. We know that others of you sometimes wait, even as late as December for next year. So again, market conditions are going to change, but some of these mistakes that we really, want to avoid, obviously, are buying high-priced inventory. We do have a few war stories from this year of companies that have been caught with very high-priced inventory. As we all know, metal prices on most commodities were very expensive for a good part of 2022, but obviously they've tapered off. Unfortunately, if you were hoping that we would report out that volatility has disappeared, you would be wrong. Volatility, we still see volatility being very dominant and into next year. And actually right now, and even this year, we're seeing a lot of volatility within the metal segment. So just looking at metals as an asset class, there's a lot of volatility. And the metals are not all behaving in line, and we like that. We like it more when they behave in line. Right now, they're not, and a lot of that is from volatility, and we'll talk about that as we go. I think the other thing from a macro perspective that is going to change up your contract strategy for next year is the fact that we have uncertain economic conditions. Now, I know that I say that every year, that there's uncertain economic conditions, but 1 year ago, we were not talking about a war with Russia and Ukraine. We were talking about a European energy crisis, but not the energy crisis that we find ourselves in today. It's much worse, I think, than what we thought we would see at the end of last year. Again, these are things that unfold while we're trying to make the best of plans. So, how do you manage that? How do you, respond to that? And we're going to kind of walk through some of that a little bit. So we've talked a little bit about, or what we see is the uncertainty that we see in the marketplace, and that causes some hesitation. What strategies should you use? And we've seen a lot of not only the price volatility, but now we've got inflation that is, we still have inflation. We have some, we see some signs of inflation slowing, particularly in commodities. We see it slowing, which is a good thing. But how does that impact demand? Depends on what industry you're in. If you're in an appliance industry and you're serving retail customers, you're looking at different demand signals than if you are a heavy equipment manufacturer and you're selling into municipalities, for example. You're looking at different demand signals. So we've got demand with a, maybe a slower economy kind of coming in together. That's a little bit different than where we were a year ago. So how does that factor into what you're doing? And I've talked about the geopolitical risk factors. And again, those are ongoing. And so it's a lot of volatility. It's more than what we typically see. Obviously, it's a lot more than last year. And so we've got to change up our strategies a little bit this year. And we're going to talk you through how we do that. So I did a little pulse question surveyed our internal team to say, how much are we hearing this like we did last year? So I wanted to know how many of our clients are currently getting pressured to make some decisions about next year. We've heard not as much as last year. Last year, when the markets were a little hotter from a commodities perspective, there was a lot more pressure to respond. Service centers saying, hey, we're running on, we've got limited allocations, you got to get your book of business in sooner. That's something we heard last year, a little bit less this year, but if you feel otherwise, feel free to, throw it in the Q&A or the chat. We always like to hear kind of what people are seeing in the market. Now, again, we're kind of hitting you up a little bit early. We're in August. So it might be a different story in a month's time even. So from our vantage point, and this is part of this presentation is more how-to than it is kind of what's the market doing right now. But again, we're going to try to do our best to blend the two together. One of the things that we see with a lot of our clients is really whether or not they understand the macro trend that we're currently in. And when I say macro trend, I don't mean, what's the economy doing per se. I also mean, what are the metals doing per se? What are commodities in general doing per se? So for example, and when I specifically say short and long term, we're meaning, 12 months on the long term. Short term, I mean the next 30 days. So the reality is companies buy for the long term, but when you time that buy, you're definitely looking at short term conditions. And when I say what kind of market, I really mean, that bull market, a rising market. Are we in a bull rising market like we were in September of 2021? Or are we in a sideways market? And you're going to see, we're going to talk mostly, I'll suspend the suspense. We're pretty much in a sideways market right now on August 17th. Of course, that can change. Or are we in a bearish market? And in some situations, we find ourselves in what I call a bifurcated market, right? So some of the base metals are a little bit bullish, some are sideways. And I would say the ferrous metals are looking more bearish, with the exception of plate. So that's what's interesting about 2023 and our long-term outlook than what we've seen in prior years. And that bifurcation is going to require us to kind of mix up and look at our strategies a little bit differently. So in the next few slides, what we're going to do is I'm going to share with you technically 4, but on 3 slides, I'm going to share with you 4 macroeconomic things that we look at to help us understand the big strategy, the macro strategy. And then I will turn the mic over to my colleague, Nicole, who will walk us through what's happening with some of those individual metals, because each individual metal might require us to do something a little bit different. And again, not knowing everything that all of you buy. Typically, our clients are buying a mix of metals. They're buying a little bit of carbon steel, some aluminum, stainless steel, etc. So with that, I'm going to just share with you two macroeconomic things that we study deeply. And when I say deeply, I mean all the time, monthly, daily. And that is, I've thrown two things into one slide here. The purple line is the CRB index, which represents commodities, including oil. So oil obviously last year was running a lot hotter than it is this year right now. So I think this morning I just looked at oil. I saw oil prices are trading about $86 a barrel. They've been as high as 120 plus. And oil is a key component inside of commodities. So again, we've seen commodities go up. You can see this chart here, from 2020, we were pretty solidly, rising up until the last couple of months. Then we saw quite a dip, and now it's moving in a more sideways direction, but still within a bullish trend, although, and we take many months, we look about at least 3 months before, we want to see 3 months of the same trend before we switch whatever that macro trend is. So CRB is kind of still in a bullish pattern, but looking decidedly sideways from a short-term perspective. I like to lay it against the US dollar index because, and those of you who have heard us speak before know, the dollar and commodities typically trade in almost a perfect inverse correlation. So when the two are moving together, as they did for some point in time this year, typically you're looking for one of them to correct. And in this case, you saw it was commodities. So again, that inverse relationship is still there. The US dollar is trading at a multi-year high. That typically means we have a lower commodity price. So again, that's the relationship that we look at to help us understand what's going on. So if anyone has any questions about that, feel free to pop those into the Q&A. But again, this is a big macroeconomic trend that we look at. This is telling us that commodities are maybe moving sideways. A strong dollar is typically bearish for commodities. Commodities have a close relationship and correlation with industrial metals, which is this slide. This is the DB Base Metal Fund. And same thing, it's got kind of the same shape as CRB. So again, we're looking at planning for next year, looking at our long-term and our short-term strategies. What should we do? What market am I in? What market are the metals that I buy in? And for most of the last couple of years, we've been solidly bullish. We've been able to say, and this was obviously right after the pandemic, all the way through, until kind of mid-April, early May, we could say we were in a solid bull market. Bull market means we have to deploy a different strategy than we would in, say, a falling market. And so this is kind of interesting, right? We can look and say, well, we're clearly no longer in a bull market. What kind of market are we in? And at this moment in time, we're in a sideways market. So if you were needing to create a contract structure and connect and get your contracts underway by September 1st, you would be making decisions primarily based on a sideways market. So you're going to hear my comments about strategies really be related to a sideways market. But with that, I'm going to turn the mic over to Nicole and have her walk us through some of the metals. So I think aluminum's up first.
Sure. Can you switch it over one more?
Oh, I'm sorry, actually, my mistake. This is still my slide, FXI, and let me just give it another 20 seconds. Sorry about that, Nicole. So FXI relates to China and share prices in China. We use this because we think it's a better measure of the health of the Chinese economy compared to, say, their Caixin PMI or some of their GDP data. So as you can see here, China's been pretty bearish since January of last year, which has been very different than the US market. Recently been somewhat sideways, although we can see it's been down fairly recently, certainly since July. A lot of that has to do with the COVID zero tolerance policy. That's one element of why it's been down, but also a property sector that is really in trouble. And we're seeing China deploy a number of different things to kind of, I feel like they're taking a page from the Fed handbook, pump more money supply, lower interest rates. That tells me they're trying to not juice up the economy, but keep the economy well supported. So, you know, when we look at this, what's the implication for all of you from a purchasing standpoint? You know, if China is in a bear market or in a sideways market, that is going to weigh down the commodities and metals index. And that's what's happening right now. Now, if China chucks their zero COVID policy, which some think they will chuck it in the next, you know, as soon as in the next 30 days or so, if that should happen, if their economy reopens up, if some of the, you know, pumping of the economy starts to take effect, then you might see a change in Chinese demand, which of course could really impact markets as well. So with that, my apologies, Nicole, now you are back up with aluminum, if I'm not mistaken.
Yes. So as Lisa stated, we're going to begin with aluminum. The previous uptrend reversed in early March, and aluminum prices fell into a strong downtrend that most recently bottomed out in mid-July alongside other base metals. Prices remain consolidated and are currently trading within a range last reached in June of 2021. While other base metals like zinc and lead have broken out upwards, the sideways trend for aluminum has led to an overall uncertain market trend with directional indecision. In spite of declines over recent months, prices right now still sit considerably above their pre-pandemic trading range. Should prices continue to break down and we see consistent declines, that could be considered a continuation of the macro downtrend. Should prices break out upwards, specifically in the range that we saw the previous breakdown continuation happen in May, that would suggest a trend reversal. For now, though, the outlook for aluminum remains sideways. Next, I'd like to move on to nickel. Like aluminum, the uptrend for nickel prices reversed in March after the historic nickel squeeze. That's why the chart looks a little bit different than the other metals around that time. It was followed by a sharp drop when trading resumed, and then prices slid into a steady downtrend along with the other base metals. The LME nickel contract continues to struggle with low liquidity, both open interest and which is the number of contracts, and low daily volume, which would be the number of trades. And that has fostered slow overall price movement, at least relative to other metals. Like other metals, though, the downtrend did hit a bottom in mid-July, and prices continue to move sideways from there. Like aluminum specifically, prices have yet to break out to the upside or downside. So for nickel, directional uncertainty remains uncertain. A larger catalyst in the coming months would be necessary to push prices out of the current trading range. Next, I'm going to move on to steel. To begin, we're going to start with hot rolled coil, and that would be the blue line. Unlike the current sideways trend amongst base metals, as Lisa mentioned, hot rolled coil remains decidedly bearish, as you can see there. It's a pretty deep slope. Prices continue to incur week over week declines, and in addition to sitting almost 57% beneath their all-time high, they've also notably fallen beneath the high before that, which would be the 2018 high. Prices still remain at the top end of their pre-pandemic trading range, but they sit solidly beneath the $1,000 per short ton mark, and they continue to decline. Now, in contrast, note the red line, which are plate prices, and they have notably diverged from other forms of steel. They remain consolidated near record highs. Prices did see modest declines at the beginning of August, following a month-over-month increase in July. Those declines followed announced price decreases from steel makers amid the record spread between hot rolled coil prices and plate prices. And in regards to that spread, hot rolled coil prices are now less than half of plate, and the spread has extended beyond $900 per short ton. Should plate see continued declines in the coming weeks, that could factor into the beginning of a downtrend. But for now, plate prices remain in a sideways direction. If you're interested, we have an annual outlook that is coming out next month that will cover these metals a little more in depth along with forecasts, as well as a handful of other metals. But I'm going to turn it over to my colleague, Don.
Thanks, Nicole. Before I get started in this, I just wanted to point out something on Nicole's slide. There's that huge gap between coil and plate. Thank you. As we look at strategies and getting your stuff ready for next year, it's something that some of you may want to look at. There's a pretty good overlap between what you can use as plate or coil. When there's a spread as big as that, if you're currently using plate, you might want to look at, are you able to switch over to coil for some thicknesses? A lot of times between 1/4 inch and 3/4 of an inch, you can use plate or coil. It's a kind of a nice little game to play back and forth, depending on, what is better for you pricing wise. And right now it's coil. It's probably going to continue to be coil for some time. Just something that you should look at if you have that ability. Okay, next slide. Thank you. So we're looking at some questions that people kind of ask, and what should you really be asking? What's a little more in depth? A lot of people, the first thing they get to when they're looking at setting your strategies going into next year is, what contract mechanism should I use? Yeah, that's not really what you should be looking at. You should be looking at, what kind of market am I in? That's what will determine your mechanism going forward. So don't start with, what mechanism should I use? You have to do your homework. You have to look at the forecast, find out what's best for your company going forward. But it starts with, what is the market doing? Next slide, please. The next thing is, how much spend should I lock versus what should I let float? When I'm looking at what should I really mitigate my risk and lock down and fix using whatever, or should I just kind of let it ride? But that's not really where you should start either. It's a portfolio strategy. So are you using a portfolio strategy, or are you just trying to lock something in and let it go? Or are you trying to buy the best you possibly can and you're playing the market, which is super risky? It works, probably 1 out of 4 or 5 years, you're rock star, and then you're unemployed the other years. So you should really look at, how can I get into a portfolio strategy? If I have enough tons, can I spread it out? That's kind of where you should go there. The next slide, please. This is a big one. When there was a big constraint on material, most people increased their number of suppliers. Had to. Necessity dictated, I have to find more suppliers or I can't get material. So do I still need to expand my supply base? We're still fielding some of those questions as the material loosens up and it's more available kind of across the board, really. Some metals are more available than others, but I would say across the board, they're all more available than they were this time last year. You really need to ask yourself, do I have the right source? Some metals, you are going to still need a bunch of sources. You'll need some global sources. Some specific metals they'll be tight. They'll be as tight as they were last year. And with some of the things going on in Europe with the energy crisis, they actually might become tighter. But that's not going to be the case for all the metals going forward, like it was 12, 18 months ago. Across the board, they were all tight. It's not the case now. You need to really assess your sourcing strategy, your global sourcing. Do I need all of these suppliers? Do I not? Next slide, please. Okay, so this is kind of the meat of what we're trying to talk about. So most people aren't executing contracts right now. We're not signing contracts, but it's time to really do your homework. You need to get your things together. Look at your cost models. Look at your forecast. That's a big thing. Your forecast is really important. So what kind of demand am I going to need for my metals going forward? A lot of times in sourcing, that's kind of the last piece that people look at, but you really need that to build your strategies. How many tons am I going to have? Do I have enough for a portfolio strategy? Do I need to use more than one mechanism? Can I use 2 or can I use 3 mechanisms? That's going to be dictated in part by what your demand is. So you kind of need to get that going. When did you last take a price adjustment? That's important too. You need to make sure that you have all that going into your contract negotiations. Maybe you're at a high point because you haven't adjusted in a while, or maybe you're really at the bottom because you just took an adjustment. You'd be surprised how many people don't keep track of when those adjustments are. It sounds like it would be pretty basic, but I just talked to somebody last week and she said, hey, I'm buying copper. I have multiple suppliers. Some are giving me an increase and some are giving me a decrease. How can that be? I just asked, well, when did you adjust price, the same price point, the same time for all of them? And she said she didn't know. So that's one of the things that you have to look at, part of your homework. You need to get all the information ready so you can make the best decision going forward. Next slide, please. Okay, so we're talking about what market are we in and where do we think we're going to go forward? And I'm trying to illustrate how important that is. I have a 2021 spend and a 2022 spend. And then the chart off to the left shows for hot rolled coil what happened. 2021, it exploded. 2022, it's coming back down. So what I did is I built a little model off of 30,000 tons. And what would have happened if you fixed your contract at the beginning of the year? What would have happened if you had an index and followed the market? If you did spot or if you did a scrap contract? And you can see what worked really well in 2021 was terrible in 2022. The spend numbers are a little bit different because there's only 3 quarters in there for 2022. Obviously, I don't have the data for the last quarter, but it would look very similar to the 2021. And is what you see there is in 2021, if you would have fixed your spend on the 30,000 tons, and for simplicity, I put them the same every month. I know no one actually buys like that, but that's how I ran the model. If you look at the difference between fixing your contract at the beginning of that up market and just following with an index or spot, you can see there's over $10 million of difference there. That's roughly a 50% increase in your spend between a fixed and following the market. Scrap is going to be similar to a fixed. Really is what you have here is you have scrap and fixed contracts. Those are 2 different mechanisms that get you kind of to a similar effect. Scrap floats around more than hot rolled coil. So it's kind of trying to tie you closer to a fixed. And is what I modeled out on the scrap is basically what would be available. Scrap contracts work on a base number and then some sort of range. Outside of that range, you take some kind of adjustment. And then 2022, it's exactly the opposite. By the time 2022 is done, you're probably going to see exactly the opposite. It's going to be almost a 50% increase from if you follow the index versus fixing. So it's super important to know what the market is doing. So forecast is really important, being aware of what's going on, where it's going, and then picking the right index, the right mechanism that goes along with that. It can be the difference between tens of millions of dollars. Next slide, please. Moving into aluminum. Aluminum is different than steel, obviously. There's not a ton of different mechanisms that you can use like you can in steel, but it's what's important in aluminum is making sure that you have the different components, break it out. If you're getting one number, if you're buying on a single number, there's all this other cost structure that you don't have visibility to. And every time you don't have visibility to one of these price verticals, you're probably going to pay more than you're supposed to pay. It's just how it works. So for aluminum, the best practice is get the pricing for as many of these components as you can. You have a base, you have a conversion cost, you have a Midwest premium, freight, all that needs to be broken out. And then you can negotiate on those individual verticals. And then when you land on it, you keep it fixed. Conversion costs, for instance. In our should cost model, we have a number. You can take that to your supplier. Hey, here's the conversion cost. Your supplier might balk at that. They might say, well, it's actually some number a little bit higher. That could be, it's just a model, but this is a start point to break it open so that you can have the conversation. And then the great part about this is once you have that open conversation with your supplier and they tell you where the model's not quite right, you can make the adjustment and then it's locked in. Then it's really the supplier's model. they're kind of stuck on that. Then you can keep those prices fixed. And then as base price and Midwest premium move on aluminum, then that's what your price should be moving. It's always best to get the most price transparency you can. That's kind of best practices for aluminum. Next slide, please. Okay, there's a couple different things, kind of how everyone used to do it and how we should kind of move going forward. Probably heard me talk about this a few times. There's following the market volatility, like I showed you earlier on the slide. Sometimes that's great. Sometimes that's the right way to go, but you have to forecast it to know if it's the right way. It can't be just a guess. I'm going to follow the market. Well, that's kind of the easiest way to do it. That's the standard. That's what we've always done. You hear that a lot. You need to know that volatility, and maybe following the market isn't the right way to go. Like I said before, it can cost you a lot of money just following the market. You need to forecast the volatility. It is a forecast. It's not going to be perfect, but directionally, it can give you a lot of insights to how you should be sourcing your metal. That's kind of the new approach. Next slide, please. Single sourcing for supply. There was a lot of push to kind of ratchet that down, and then we saw in the last couple of years it exploded out because you just had to have the metal. You need to have some kind of balance in between there. You need to really look at what metals you need multiple sources for and which ones you don't. Now is a good time to shrink some of your supply base in some metals. Steel, for instance, is widely available now. So if you expanded that so that you needed steel, you could get it from 15 different suppliers, you probably don't need that anymore. You might need to rein that back in. If you're buying copper, for instance, stainless steel, some of those metals that are a little tighter, you might still need those, but you should still look at, reevaluate every year, just like you're doing your homework on your parts, your demand, all that. You should evaluate, do I have the right number of suppliers? Do I have them in the right location too? Just sheer numbers, that doesn't always work either. If you have 10 suppliers, but they're all in North America, you can't get metal out of North America, it doesn't work for you. So you have to reevaluate that every year. Next slide, please. Okay, and then the last one in this group, all eggs in one basket, locking up the spend using one contract mechanism. A lot of people do that. A lot of people think they don't have enough tons to do multiple mechanisms. That changes every year also. You have to evaluate what the market's doing. Last year, when the market was really hot in steel, you had to have a lot of tons to do anything with. Now, as it gets softer and softer and steel's coming down week after week after week, it takes fewer tons to be able to have more of a rounded portfolio strategy. Probably close to half of what you had to have last year. You can get some kind of strategy. Maybe you don't have 3 or 4 different mechanisms, but maybe you have a couple, and a couple is enough to kind of round out your risk. So you're not stuck in, well, if the market goes up or down sharply, then you're just stuck. You can have something that kind of balances the ups and downs out. Okay, we find that some customers think they're following the right markets, the right indexes, they're looking at the right data, but they're not. This happens a lot in long products. People that we talk to, bar, wire, it can be other things too. Those are the ones that I hear a lot. I talked to a customer a couple of weeks ago. They were following hot rolled coil to try to match up with rebar. Well, it turns out that doesn't correlate really at all. So what we looked at is plate. Actually, plate follows rebar, rather the other way around. Rebar follows plate. There's a bunch of things that make sense of why that would happen, but you should reevaluate if you don't have a good handle on the market or the index that you think your metal is following. You should look at that again. There's a lot of different ways to kind of slice and dice that. We do a lot of correlation analysis. We do it for nothing. If it works out, it's great. If it doesn't, then it doesn't, but you should really keep tabs on where it moves. This customer, for instance, thought we should really be seeing cost downs. Hot rolled coil is coming down massively, but our rebar is not. Well, that's because rebar is following plate. Like we discussed earlier, plate is really kind of hanging out there. because the drivers for plate happen to be similar to the drivers in rebar. Just something to be aware of. Next slide.
I think this is me,
And
John.
yep, now I'm going to pass it back over to Lisa. She'll run through some strategies and summaries.
Right. Thanks, Don. Appreciate it. So obviously, if we were in a bull market or a falling market, we would have a few different strategies, but I just kind of want to highlight some of the things. Now, our clients who work with us understand this because we've kind of trained them that this is how we think about the markets. But I'm just kind of giving you some overall rules and strategies, things to think about in a sideways market like we have for most of the metals. Again, exceptions noted, right? So if in general, if we see prices have recently fallen and look to be, again, recall the charts that Nicole had shared just in terms of, where we are, if something is really coming close to that bottom, I know there's a natural tendency to think, we're at the bottom now, I'm going to stock up. I mean, it is a natural gut reaction, like, oh my gosh, it's fallen so much, I'm going to get it. Which reminds me of a phrase that we always say, which is beware of a falling knife. So typically that's not the best time to make a long, like actually making a larger or a long-term purchase. But rather just kind of keep watching it. I'll tell you when you can make the long-term purchase, but continue to purchase for the short term, especially if it's just still going kind of like up and down. Because the problem with when something has momentum to the downside, it can keep falling down, which again is that knife piece. So that's why we say something like, and I'll just kind of briefly explain what we mean by resistance levels in this next bullet. Okay, so you're watching a market, you're seeing that it's falling, you're thinking to yourself, maybe, oh, this has got to be, it hasn't been this low in 2.5 years, I should buy now. We say, hold off. And the reason we say hold off is because we're not trying to time the market to the crux of the very bottom, but rather we want to have confidence that the trend is changing before we make that long-term buy. So when the trend is changing, it should look like a U or a V to some extent. And that's what we talk about resistance levels. What is a resistance level? If you think about, for those of you that maybe trade your stocks in your stock portfolio, you might hear of things called support and resistance levels. In our vernacular, when we do forecasting, we set a 30-day trading band. And that band is our expectation or our model's expectation of where we expect that underlying metal to be priced. So the resistance is the top portion of that range, and the support level is the bottom end of that range. And so this strategy is, if you're in a sideways market, okay, and the market's just kind of going up and down, there's not a change in buying strategy until that price goes up above that top resistance level. Why is that? Because that gives us more confidence about the trend direction that we're taking. So again, don't try to time those lowest of the lows because you'll find yourself on the wrong side of it. But if you are looking in, some clients, for example, some of our clients that are in the appliance industry, maybe they've got a big box retail program that they set in place now for the following year, and they have to hold fixed the price of, say, a power tool, a washing machine, a barbecue pit. So in that situation, you may look to take off your risk. Like you might say to yourself, okay, the price is not the cheapest that it is that I can probably ever get it, but I'm in the money based on my contracted price. So I can go ahead and lock that risk, lock that up, execute that contract because I know I'm in the money. Again, I think I've talked about kind of the short-term, support. So that is what we mean by the short-term, that next 30 days. Let's say that you need to create your annual contract and get it in place by November 1st. You're going to start looking at that short-term trend starting in September through October and give yourself that 60 days to kind of decide when do you want to play with the market, particularly if you're going to lock a fixed price for something. That might be when and how you would use a short-term strategy. So with that, I'm just going to kind of summarize some of the key takeaways and then share a little more intel with you after this slide. So some of our key takeaways is obviously knowing what the trend is so important. Again, the macro trend, what are we in? Are we in a bull, a bear, or a sideways market? And what are my metal trends in? Are they in a bull, bear, or sideways market? And sometimes we're in a market where you're in a rising short-term trend, but an overall, let's say a bull short-term trend, but you're in an overall sideways trend. Even that kind of plays into the strategies and tactics you might use from a contracting perspective. I do hope that if you haven't walked away with anything, that you've walked away with kind of why a portfolio strategy. Now, if you are a small buyer and don't have a big spend, somebody's probably going to throw in the chat box, well, what do you mean by big spend or small spend? I would say this is probably when you're in the multi-million dollars of spend for a particular commodity, you can definitely deploy a portfolio strategy. Don talked about from a volume perspective, maybe this year you could get away with half the volume that you had last year to do such a strategy. So it depends on the metal, but we definitely want to encourage folks to look at a portfolio strategy and start thinking. Lots of times people ask us, should we be hedging? And then we always say, hedging is a great idea, but you don't need to do 100% of your spend as a hedge. Take a portion of that portfolio and hedge it. Break out the cost structures. Don showed an aluminum model. In an aluminum, it's very significant breaking out the cost structure. It is for steel as well, but the adders and extras as a percentage of total cost are smaller than they are for stainless steel and aluminum. So for stainless steel, breaking out that cost structure is also a pretty critical activity. Again, the use of a should cost model, it's something that we do, can help with that. And obviously some of these others, de-risking the global supply chain. For those of you that are copper tube buyers, copper wire, please, please, please be looking at alternative sources for that. You should be working on that frantically right now. We're very concerned about some shutdowns. We've already seen some zinc shutdowns, as Nicole mentioned. Complete shutdowns until September, until further notice. We see that as a risk for some European supply. So if you have European suppliers in your mix, particularly if you want me to name the countries, I would say Germany, the Netherlands, Italy, those are the big ones. Austria, particularly for some of the automotive sheet products. We're very concerned about that. Make sure that you're de-risking your global supply chain as soon as you can. Hopefully you have other suppliers PPAP'd in the case of automotive. And finally, just kind of want to reiterate Don's point about looking at demand. That's really important. And getting together with your sales teams and getting kind of your ear to the ground. What's happening from a sales perspective with our business, and where are we in our life cycle? Because again, every company has a different kind of what I call recessionary life cycle of where they are in the economic cycle. Make sure you understand where your company fits in. And I'm just going to share, a lot of times we get a lot of questions. This is just a little bit about, I want to share some resources that are available to you through Metal Miner. Many of them are free. This periodic table really highlights the metals. Obviously, it's all of the metals. The colors in dark purple are the metals that I would say, have deep resources on. We have metal prices plus forecasts. Similar to what Nicole presented, short and long-term support and resistance and specific buying strategies. All of the colors in the light, all of the light purple, we are very excited to be announcing that we will be adding both prices and forecasts into our insights platform for many of these metals. These are obviously what I call, they're not quite from the book of weird and obscure, but they certainly are a lot of the clean tech metals that have come, battery metals, etc. We get a lot of requests for these. So this is kind of an exciting piece of news. I should also add our Metal Miner website. We are getting a complete makeover. We hopefully will be launching that next week. But next, I just want to share with you some of the very free resources that we have where we put a lot of what we talked about today into those resources. So for example, our weekly newsletter comes out every Wednesday. Some of you are on it. It's a great resource to say what's going on with the metals right now. What are they saying? And really, we really comment on the macro trends in that newsletter. Obviously, our Insights platform, which I won't talk about, we will continue publishing. We publish an article a day, including our deep analysis that will remain free of charge and will be available on agmetalminer.com. Some of you also use our monthly index. People use those indexes in different ways. Some of them use it just to kind of understand they use it as a tip to negotiate with suppliers. Am I moving along with the market as the market basket is moving, or is something not happening? And a couple of our last webinars have been on cost downs, and particularly going back to your suppliers, asking for those cost downs. Those MMI monthly numbers give you some ammunition to be saying, wait a second, aluminum MMI is down 9%. Where's my cost down from that? And am I seeing that in what I'm paying for those metals? And then, of course, we have a resource library. A lot of what Don and I covered today in terms of some of the strategies and tactics that companies can use from a negotiation standpoint are in our resource library. So they're designed to be very quick read. We know our attention spans are short these days. So they're all typically 2 to 3 pages and give you kind of like a highlights. I want to just pause for a moment and just ask if anybody has any questions they want to populate in the Q&A. We still have a couple more minutes. Feel free to post those there. And I know my colleagues just kind of given a link to everybody in the chat room there for that. And last but not least, if any of you found the content interesting today or might be helpful to your company, you've got some questions, would like to discuss it, basically first one that reaches out to, and I would send it the email to N. Athanas, which stands for Nick Athanas, who handles our client. He's our client relationship manager. Feel free just to whip over an email, let us know who you'd like to speak with, what metals you'd like to cover, and he'll get back in touch with you and schedule that. We still have 3 more minutes. We've got a couple questions that came in. So Don, I've got a question for you to start. And the caller wants to know, what are your thoughts on scrap or rebar prices in the near term? Or Nicole, if you want to answer that too, feel free.
I can jump in, and Nicole.
Great, Don, go ahead. Oh, it looks like he might be stuck. Nicole, you want to take that?
Sure.
Would you like me to?
Sure. Well, scrap prices have been falling a little bit due to different market factors that are going on, specifically in Turkey. For instance, they've been getting some supply from Russia, and so they've had a lower demand overall. There's also the prospect or worsening effect of global economic health, and that has weighed on scrap prices across the board of late. And they've seen some pretty significant declines in the last few months.
I would just add, as Don indicated, rebar correlates well with plate prices, and plate has remained stubbornly high. So, if you're looking for guidance on where you think that's going to go, take a look at plate prices, and that may also give you a few clues. Okay, I'm going to keep you on for a couple more seconds. If anyone here, we've got another question here. Yeah, I think we've covered it. How's the U.S. market and outlook for rebar and scrap prices? Again, it's following plate prices. So keep your eye out for what's happening with plate to get a little bit of a better sense. What's interesting is I think scrap is a little more, as Nicole indicated, a little softer, than rebar, but rebar certainly has held up a little bit better. Okay, well, with that, we're going to let you all run a couple seconds early. We know you have a lot of places and things to do, and we appreciate you spending this morning with us, or at least for an hour. Hope you got something out of it, and we look forward to seeing you again at a future webinar. Thanks so much. Take care. Bye-bye.